Sieht gut aus. Check, check. 1, 2, 1, 2. Gut, funktioniert. Vorne sind noch ein paar Plätze. Die besten Plätze sind bekanntlich ja immer vorne. So, good afternoon, everyone. I hope so far you had a great conference day, and thank you for joining us for what I believe is a very lively and insightful discussion on a topic that seems to have a strong comeback, active management. I am Manuela Fröhlich, co-founder of Forefront, the largest career network for women in asset management and finance, and I'm very happy to be your moderator today for the next 45 minutes. I would be delighted if you put your cell phones on silent, and I would also be delighted if you already collect a few questions. We can answer them at the end of the panel. Let me start by introducing my high-caliber panel. Their impressive bios are available on your app, so I'll keep introductions sweet and short. First, I'd like to welcome René Nicolodi, Head of Equities and Themes at Zürcher Kantonalbank. He's also part of the ESG Commission of the European Federation of Financial Analyst Society, sorry, tongue breaker, and he's also a lecturer on asset management and sustainable finance at different universities. René is convinced to achieve above-average results in the financial markets, an investment culture is relevant that allows for creative foresight, encourages deviation from the consensus, and technologically supports a consistent use of these talents. Welcome, René.
Thank you.
And you can applaud if you want. Great, thank you. My next guest is Georg von Wyss. He co-founded BVM Value Investing in 1997 and is today partner and portfolio manager of the classic funds. Does anyone know the book, The Great Minds of Investing by Henry Kleber in the room? Ah, there you go. Because it features profile prominent investors like Warren Buffett and Charlie Munger, and Georg von Wyss is one of them being portrayed in it. So for all those who don't know it or don't have it, go and buy it. Georg has a clear message. Business models matter, but so does valuation. History shows that buying undervalued companies leads to outperformance and that the last 10 years of poor returns for value investing have been an anomaly. Thank you for joining us today, Georg. Alex Rauchenstein is managing partner at SIA Funds AG. When he joined the SIA Group in 2006, he set up the regulated asset management company. In a career spanning more than 35 years, he has always been fascinated by value investing. Alex is certain the growing dominance of passive investing has opened up compelling opportunities for active managers to outperform. Welcome to the panel, Alex.
Thank you.
And last but not least, Damien Burkhardt, Senior Portfolio Manager at EFG Asset Management. He joined the firm in October 2024 and is the lead portfolio manager for Swiss Equities. Damien says, active management is an intellectual process. It is about balancing short-term risk with long-term value creation. And the key driver of value creation and outperformance is innovation. Great to have you here, Damien.
Thank you.
For years, passive investing has dominated the narrative, but as markets grow more volatile and complex, active strategies are once again in the spotlight. While the role of active management has evolved, its potential to navigate uncertainty, identify inefficiencies, and generate outperformance remains central to this debate. Remains central to this debate. Today, our esteemed panelists will explore where active management adds real value, how it adapts to changing conditions, and whether it still offers a lasting edge. So let's dive right into our first question, gentlemen, shall we? Active management has been regaining attention from investors recently. From your perspective, what are the primary drivers of this renewed interest, and do you think this trend will continue? René, I would like you to start, please.
So sure, to begin with, thank you very much for having me. And then, well, to be honest, I'm not sure if active management was ever out of favor in general terms. What is certain, what is clear is that the secular rise, as I would call it, of index investing, which in the US has almost reached 40% of market penetration by now, and also the coming up of new players such as algorithmic traders, has changed the nature and has changed certain characteristics of market and how active managers need to act in these environments. So for instance, the rise of indexing has certainly led to high concentration, for instance. So we have 77% of world equities being located in the United States at their peak, 22% at Max 7 at their peak. That obviously encapsulates basically the trend is your friend until it isn't anymore. And that's what basically index investing is doing. Secondly, you have high volatilities, events, short-term flash crashes that come with algorithmic traders, which provide liquidity on the one side, but take it away very fast and unexpectedly in other terms. And thus, as more and more capital is allocated to, let's say, expensive stocks by their size, that creates distortions over time. And that's basically also good ground for active managers to exploit these inefficiencies over time. Okay, so current events suggest that we are entering an era of a little bit more uncertainty and higher volatility. Just looked at the markets this morning, and that basically is a good ground, I think.
Great, thank you. We cover that in detail later. Georg, what do you think is for you the primary drivers of this renewed interest?
Well, like René said, he covered it all. We've had an enormous concentration in a few stocks, and the result of that has been that a large part of the market has been ignored. More and more money is being allocated to passive strategies, so in that sense, I think active management is less popular. We've been losing assets, so I have nothing to add besides that.
Yeah. Alex, do you have anything to add?
Just a few points, because he really almost said all. What was really interesting for me at the beginning of this year, that Goldman Sachs came out and said S&P market cap weighted for the next 10 years. Do you know how much we can expect to make per year? 3%. So if Goldman Sachs has this year, they probably positioned already last year for that. So I think, and they were pushing basically for equally weighted S&P 500. Now, I see that as a fantastic, great opportunity that active actually is coming back. And you basically see that also in other statistics. I mean, in 2006, 30% of the global equity managers had a value tilt somehow. You know how much are left? We are, sorry, George, you and me, we are the old dinosaurs. 5%, divided by 6. So it's a clear trend, but we think it has broken. And this volatility is pretty interesting.
Damien.
Yes, just a few more points probably. I think, and I'm quite convinced that active management has probably a more important role to play over the coming years. Just looking back, we've seen this massive flows into passive and obviously into the Max 7 trade. Markets were massively thematic driven. And the reason I think active management has a bigger role to play is firstly, we are already seeing it. Massive outflows out of the Max 7 into Europe again. So this creates dispersion, which is a requisite for active management. And secondly, there's just more risks to manage. Think about the trade risks, think about the economic risks, the geopolitical risks. Those are all risks that you need to be understood, and they need to be actively managed. And those risks will actually drive dispersion, I think, in performance and in returns. And that's why.
Great. Thank you so much for the overview. Now we dive a bit deeper. Let's look at the active approaches. Alex, periods of volatility and uncertainty often served as a test for active management. How do you see active strategies providing their value over passive approaches, and in what type of market environments do they truly shine?
Yeah. I think you can look at the market today. I mean, everybody is nervous. Now, if you don't own what you really own, if you just believe that you can cover your portfolio, equity portfolio with an MSCI World ETF, and on top you have an S&P ETF, owning twice the same. And I have so many meetings in Germany, for instance, where people just said, you know, I don't need to pay an active manager for what? I get MSCI ETF for 6 basis points if I'm large, and S&P for the peanuts as well. So why should I pay? Now, that's fine when the line goes up. But if stress is in the market, I don't think that these guys don't really know what they own. Second, they are not really feeling that comfortable to buy the dip. Of course, everybody tries now to buy the dip back because they think NVIDIA is now cheap. Yes, it's cheap to relative a couple of weeks ago, but in our view, it's not really cheap. So I strongly believe when you know what you own, and we try to own as much as we know about us, because I have 100% of my own money in my own product. So basically, we really try to understand, and that offers then fantastic opportunity to buy more of the same. You know, I mean, Warren Buffett always says, why is equities one thing people hate when prices go down? Other products they like if prices go down. Prices go down, then you can buy more. And if you don't know what you own, then it's maybe difficult.
Thank you. René, what would you like to add to that? What's your position?
No, well, I firmly believe that active strategies can provide an additional value over time. Now, probably not always and in every market environment. And then we probably also need to differentiate between different active strategies that have grown over time. So from bottom-up fundamental stock selection to active quantitative strategies. So the characteristics of an investment process play a great role. Do I play full value or deep value or growth strategy? So this matters. Then in general terms, what matters according to my understanding over a few years is, well, market volatility usually helps. It creates dispersion. It creates opportunities to buy more stocks or different stocks. It re-evaluates markets in certain extents. On a sub-level, on a deeper level, dispersion of the returns of single stock helps. So if you don't have any dispersion, it becomes much more difficult to create outperformances. Everything moves in the same direction. And the third general element, I would say, is market breadth. So market breadth as an indicator of market health. If a lot of stocks outperform the market versus not many stocks outperform the market, then a healthy market helps to outperform. And these scenarios also drive the percentage of active managers that are able to outperform the market versus not.
Yeah, fantastic. Thank you so much. And we talked about the outperformance. Now, as we know, active management has underperformed badly for years, including a particularly challenging 2024. Why are you nevertheless optimistic, Georg?
Well, because the concentration that Alex mentioned, or everyone's been mentioning, has gotten so extreme. That has, when phases of high concentration are absolutely correlated with poor performance for value strategies. Value does very well as a factor when concentration falls, and that's what's happening now. You know, as people, as all of the factors that drove people to buy the Magnificent Seven and to put all their money into index funds and buy more Magnificent Seven, as that goes into reverse, concentration falls and people look for alternatives. And there's lots of alternatives, but of course, over the long run, we think the most exciting one for us, it's the most boring one, but probably the one that makes you the most money, is value investing, because that has been proven over time to be an excellent strategy. And so people are coming back to it after ignoring it for many years. That's why I'm optimistic.
Great, thank you so much. Damien, what forces do you see changing in 2025, explicitly to make the environment now more attractive for stock picking?
So I think Georg gave the answer. Pretty much what we saw the last few years was what I would characterize as convergence, the convergence trade into this Max 7 that led to these high concentrations. So going into 2025, what forces are changing? What's really changing is what I would say is divergence. So we are seeing a divergence in stock returns. So European stock dispersion compared to the US is the highest in 11 years. So that's a fascinating statistic. And secondly, also a divergence in policy. Think about the inflationary policies we're likely going to see in the US. Rates will probably stay higher for longer. In Europe, rates will probably go down. But there's also divergence in terms of economic variables, not just inflation, but also consumer confidence is coming down in the US, but it's actually improving slightly in Europe. Or city economic surprise indices are moving down in the US, up in Europe. So this divergence, I think, is a necessary requirement for active management to be able to outperform. And I think that's the reason why I think the setup in 2025 and beyond looks better. So
while the future may be brighter, generating consistent alpha remains a core challenge. Let's unpack what drives sustained outperformance, René. What key factors contribute to sustained outperformance, and where do you currently see the most compelling opportunities?
Well, probably there's no magic formula to generate alpha, as we all know, because it's a multidimensional process. So what stands in the center usually is a well-structured, consistent investment process. And I stress consistent, because basically either you make a decision to go for deep value or any other, but the consistency of the process over time is very important. What in my experience doesn't function is if you flip around the investment process and change it according to every single cycle. That will probably destroy alpha over time. And the lack of consistency is usually also the reason why mid-long term no alpha is generated. Then said that, thorough research, okay, being a factor investor or a fundamental investor, thorough research on your KPIs is elemental. Active risk taking is key. So if you don't take any risks, you won't generate any alpha. That again requires a certain conviction, a belief with regard to active risk taking. If you don't have these convictions to have the structural bets over time, you will not be able to extract the alpha over time. Okay, if you flip around all the time, that will destroy alpha. And thirdly, the balance. So yes, strong beliefs, strong convictions, but not absolute paradigms. So you need to have a certain flexibility in certain moments of time to adapt your convictions to the market cycles and to the events. And if you do that, all the things in a consistent way over time, then you have a higher probability to generate outperformance than not.
Great, thank you. Let's zoom out again, Georg, sorry.
Okay.
On one theme we're seeing across markets is the increasing, or we talked about the increasing concentration. So has that trend to great market concentration created market inefficiencies to exploit? And you might have a few examples or use cases to want to share.
Yes, of course. It has. It's what's been driving us crazy over the last years, is that especially European stocks have gotten cheaper and cheaper and cheaper because they are not high-tech, they're not sexy, they're not the Magnificent Seven, they're not American. And as we knew 2 months ago, not being American was bad. It's funny how that changes. And so it turns out that we are 80% invested in European, mostly small caps, just because nobody cared. They've gotten really, really undervalued. It turns out when we look at the indices, that confirms that we're in the right spot. The PEs of European value stocks just got very, very cheap. So that's the inefficiency that we're exploiting. That's the one we know. I'm not saying it's the only one. It's the only thing we're looking for. That's all. So we see what we're looking for, obviously. Especially stocks that are not part of an index. So very small caps in general that are not part of the ETFs that work really well or have worked really well. Those things are completely neglected, and that's a great place to invest, especially for the long term. Mm-hmm. So that's what we're doing.
Yeah. I'll go back to Damien. Can you walk us through how you add alpha with your high conviction approach in innovation investing? How do you assess the innovation, and what is your conviction framework?
Sure. So at EFG, or the New Capital Swiss Small Mid-Cap Future Leaders Fund, what I focus on is really understanding the innovation drivers of companies. And just to take a step back, looking at companies through the innovation lens and why it matters, over the last 20 years, I would say there has been a bit of a silent revolution in terms of the factors that are really driving the performance and outperformance of stocks. And it's actually intellectual property, it's patents, it's knowledge. And when I look at the traditional investment analysis, they look at, and when I'm meeting with other analysts, they look at traditional metrics like return on equity. They ask the question, how fast is the company growing? How fast is the industry growing? But they don't ask the question, why? Why is the company able to gain market share? Why is it able to outgrow their peers? So a lot of that is really understanding how a company creates value through its innovation process. How does it think about creating new products? How does it think about staying relevant for the future? And what we actually show also in our analysis, that companies also in Switzerland investing more in innovation or more in R&D are actually the ones that outperform. They have higher total cash flow returns and also higher cash flow growth. And on a country level, so lifting it up from the company level to the country level, why a Swiss product? I think it makes intuitively sense because Switzerland is the #1 global leader in innovation. Actually, for 14 years in a row, by the World Intellectual Property Organization, we've been #1 globally, and also #1 when it comes to patents per million inhabitants. So that's the great ecosystem we live in, and that's the one we play and try to find value.
Brilliant, thank you. And we go back a little bit later on the Swiss equities. But first of all, I would like to speak to Alex again, or ask Alex the next question. As the value investor, when assessing undervalued opportunities, what specific methodologies or proprietary frameworks do you rely on?
Oh, proprietary frameworks. I mean, it's a bit a high word. I mean, we call our company strategic investment advisors. Why? Because the founder of our company was my professor when I did my executive MBA 23 years ago. He has a Harvard background, he was co-writer of Harvard cases, and he has a fantastic book called Strategic Logic that describes how can it be that a company A can be more profitable than a company B, being in the same sector. And basically, we try to implement that. And it's interesting, you know, I mean, I don't know how many of you have heard of a listed company that produces sausage skins, just the skin of a sausage. There are 3 in the world, third one being Chinese. In 2019, out of 35 names in our portfolio, we had 2 of them, the #1 and the #2, controlling 65% of the global sausage skin market. Why is that interesting? Because my former professor says, first, you have an oligopolistic market, which is much better than having 20 competitors. Second, the buying price of a sausage skin for the buyer is 2% relative to the production cost. So he's not really price sensitive, which makes it fantastic. And guess what? I have not checked the prices today, but in COVID, when MSCI World went down 30%, Viscofan, which is the #1, went up 30% in 3 months. Because hedge funds suddenly realized that the sausages that are sponsored here at the event from Braun von Wies are actually fantastic, because the salamis, Weisswurst, whatever, we make money on that. So basically that is in a nutshell what we try to call our proprietary process.
Yeah, great, thank you. I will remember the sausages, so will all of you. So
hopefully.
Great story. So yeah, we have a couple of questions left, and I would like to focus now on the individual investment strategy. So Damien, you started already to talk about your fund, the Swiss Small and Mid-Cap Fund. It's called Future Leaders, with a focus on innovation. So in a bit more detail, why do you believe small and mid-caps are a better playground for active management compared to the large caps?
So when we talk about large caps in Switzerland, we talk about the SPI. And the issue with the SPI, we have 3 big names, Nestlé, Roche, Novartis. They account for roughly 36% of the weight, actually 45% of the SMI. So it's hugely concentrated. But unlike the experience in the US with the Max 7, those 3 haven't been that magnificent at all, actually quite the opposite. They've been big underperformers over the last 5 years and over the last 10 years. Just to give an example, the SPI did 80% over the last 10 years. Had you excluded the 3, you would have made more than 100. So then the question becomes, where do you find that magnificence? So the magnificence in the US Max 7, they are magnificent because you have companies with high barriers to entry, high pricing power, high earnings growth, and they're at the technological forefront. And those are the characteristics that we find much more in Swiss small and mid caps. So those are the names that are highly innovative, they're highly research and development driven. That's where you find also a lot of companies with a lot of pricing power, with strong market positions, high market shares. And then you look at the performance over the last 20 years. Actually, Swiss and small and mid caps have massively outperformed almost all other asset classes, even including the S&P 500 over the last 20 years up until summer of last year. And that's something that most foreign investors certainly don't know. So it makes sense to play in the small mid-cap field, and it's also an area that is also a lot less efficient, where it pays off, like I do, to speak to management, but also talk to the R&D heads, the research and development heads, to understand how they do innovation.
Great, thank you. So we're definitely positive for Swiss equities, and I'm sure you are as well, René.
Well, yes, I can fully subscribe what Damien has said. So we also manage roughly, 1.6 billion in small mid-cap, Swiss small mid-caps, and it's an area that is highly attractive and interesting. And we have a huge coverage on the sell side research part, which helps us to get very close to the companies. At the same time, in certain moments, size matters, so we are quite a large investors in Swiss equities. Therefore, the connection with the company, the closeness to the management, to understanding the business model is absolutely essential in this part. What we also do is a very active engagement, the stewardship approach. So when things do not go the way we want it to go, we take up the discussion with the company on governance topics, on compensation topics, board election topics, and other things that matter to us, because the company usually listens, and it helps us to be very close and a stable investor for the company in Switzerland.
Great, thank you. Do you want to talk on what other investment ideas you're currently promoting quickly?
Well, if I can do marketing, no,
just subtle.
We are
just on a high level.
Not doing
please.
marketing, but we are quite a large,
Yeah.
large investors in Switzerland, or asset manager in Switzerland today. Where we have a focus is obviously still sustainability topics, because we believe in the long term, even though the temperature is going a little bit more cold recently in topics. We believe that sectoral, structural trends such as from climate to water to circular economy will be topics that will be challenges for the long term, and they need financing for the long term, and they provide sources as alpha for the long term, and therefore we have a focus there among many other things.
Right, thank you so much. Alex, some active managers focus on short-term tactical moves, while others emphasize long-term. You're a promoter of long-term. Where do you place your emphasis, and why exactly in your strategies?
I mean, our fund is called Long-Term Investment Fund. I think that basically says it already. I think, we believe it's extremely difficult to be right between 3 to 6 months out, but much easier to do a prediction over 3 to 5 years. And we see that. And basically, we do arbitrage in the sense that we have the long-term breadth, and hopefully our clients as well. I mean, if you look at a company that provides parts that go into aero engines for Airbus and Boeing, and you're basically seeding because you're sponsoring that everybody has your part in, and then you collect for 20 years, I mean, a lot of short-term analysts have to put a sell on this stock. And we are extremely happy to buy, because we know exactly what's coming. Not always, because then COVID comes and then you have another chance to buy it back, etc., etc. So long-term time horizon is important for us. Nevertheless, the fund is daily, and we can keep that daily liquidity because we monitor that, and we are small. Sometimes small has some sex appeal. And we have now 23 years of history and 9% per year, 200% relative to MSCI World outperformance, but not on a calendar year, unfortunately. So we think we are back. And interestingly enough, on 5 years, it's fascinating that if you look at something called international equities, which is MSCI World ex-US, you see value already massively outperforming since 5 years. So we don't have to dream about the renaissance of value coming back. In international equities, it's already there. Growth component was giving 5%, value component was giving 11%, we delivered 14%. So we think we are back in the game. Thanks.
Super, thank you. And Georg, you're also a convinced value investors. What about your style? We said that before, makes you optimistic, a bit more maybe in detail about what you're doing in your portfolio and why your style is keeping you on the positive rise.
Well, our style hasn't changed, right? So we're just doing the same thing. The reason I think it'll work is because people will start paying attention again to valuations. The reason value investing works over time is because people underestimate companies. There may be some bad news, there may be a short-term influence like Alex just mentioned, the cycle may be going against them, maybe you have a management problem that can be solved, and all of those things lead to people whose time horizon is the 31st of December for investment returns to sell. And so things get too cheap. Now we've been seeing that across the board in so many stocks, especially in Europe, and the upshot of that is that you can buy some wonderful businesses cheaply, and if you think you have a business that over time is going to generate value because of whatever competitive advantage that they have, or whatever asset that they have that's valuable, and if you hold that, then over time that does work. And as people start to pay attention again to valuation and don't just buy the S&P 500 because that always goes up. Once that starts going down, maybe they'll go back to some of the old things that work, and I'm sure that paying attention to valuation has to be one of them, because if they don't, companies will get bought out in other ways. If the private market investors may come in, owners may take them private. There's all sorts of catalysts that then bring out the valuation. You just have to have the patience to wait until that happens, and until the market corrects those mispricings. And I think that's going to happen again now that the momentum trade is not the surefire way to make money.
Yeah, thank you so much. So thank you all for those excellent insights with so much valuable information shared. It's your time now for the audience. We're good in time, so we have a time for some questions. Keep it please short. Let us know who the question should be directed to. Wow, there's many questions already, so I'm glad we saved so much time with that.
One simple question. If you're looking at the new developments of artificial intelligence, it's quite obvious that AI outperforms traditional approaches quite significantly. How do you use artificial intelligence?
Who wants to take that?
I'm not sure that I would 100% subscribe the message. Well, AI, it's clear that AI outperforms always and in every yeah. So
the stocks, yeah, or the technology.
Exactly. Yeah, exactly.
No, not the stocks, but the approach. The approach clearly uses far more data than anybody of us.
So what we did for the past 5 years, actually 7 years, so we tested a lot on machine learning and AI algorithms. So we spent roughly 3 to 4 years just testing and doing research on what works and what doesn't. We just launched a few months ago a small cap AI-driven active strategy. And from the back tests, it looks very good. Well, the back test is one thing and the reality is another thing. Well, year to date, it outperforms, which is good. So yes, I'm also a strong believer in AI technology as a source to generate alpha, but it very much probably matters. What exactly are you doing? What kind of algorithms are you implying? What kind of transaction costs are you incurring? How do you really implement the technology? And that is, at the end of the day, probably key in order to generate outperformance over time.
Yeah, anyone? Do you want to add something?
Yeah, what we do is we're trying to understand companies very well, so to really know them, like Alex described. So it's the same thing. So what the problem we have is to process the information about companies that's out there. And a lot of that information, well, one is the financial statements. Okay, well, it's easy to analyze that. You don't need AI, because that's just traditional securities analysis. But number two is analyzing conference calls and statements by managements. And there, we use AI. Some of my colleagues are testing it in terms of condensing information and making it a faster process to analyze that stuff, what people said, to take out the verbiage, to the unnecessary words. But at the end of the day, for now, it's still all about figuring out what the company really meant when they said something. So sometimes, when you ask a question, what's just as interesting as the answer is how they didn't answer the question, or how they avoided it. You don't need an algorithm for that. You need common sense and human intelligence, because you have to read body language, and AI can't do that yet. So, or at least I don't think so. But so a lot of what we're trying to do is we're trying to interpret companies, because at the end of the day, you want to know what the story is of a company, not in the sense of a stock story, but what they're doing. And for that, I think you still need to apply human intelligence. I don't think AI can do that yet.
I could say that it's nearly a full new panel now, so because I'm just conscious that, organizer for next year, we do that panel on AI, please take a note, because there are a few other questions, so I just conscious about that. Is that okay? And then you can discuss that later. We have a question here, and there was another one over there.
I have a question to Mr. Nicolodi. Would you ever, or have you ever recommended to your ZKB colleagues to buy the fund of George and of Alex so they can invest into a value fund?
So I was an investor in George's fund for roughly 6-7 years back in, I think, to be honest, 2002, 2003.
Great.
So we have ex-ZKB analysts which joined Georg's boutique, and so I've always looked up at how they do value investing. Now, I'm not in the fund selection team, so it's not my part of the business, but the important message here is, what kind of clients do you have? Does the characteristics of the client match the characteristics of the strategy? So, and potentially yes, potentially not. So I'm in a highly institutional pension fund, consultant-oriented area of the business, which means that I have obviously a long-term investment horizon, but probably not that long. So if I start to lose money after 12, 18, 24, 36 months, and then that strategy turns around in 48 months, well, probably my clients won't be there anymore. So the match between the clients and the strategy is quite an important one. Okay. I'm not sure if I made myself clear.
Another question here?
I have more like a remark.
For
The
sure.
proof is in the pudding. I mean, if you take the research, it shows it quite clear that the majority of asset managers underperform. So you have to show on a consistent basis. And you said 18 months to 24 months. I mean, if you do that, I know you're going to lose, for sure. Maybe not in small caps. But you have to prove that you have 3 years, 5 years, 7 years, 10 years track records of the cost that are better than benchmark, and you have to define a sensible benchmark. Then you really have, then you have a reason to say, we're doing it better. I think we only have 0 alpha. You have to prove that you're better than everybody else you created.
I fully agree. So the 3, 5, 10-year track records help you to gather the money. But the short-termism, at least at institutional level, is quite high. So you will always lose money if you start to underperform after the periods that I've mentioned. But the long-term track record is an absolutely crucial one. That's I fully concord with that.
But I would argue your clients don't make money, but not because of you, because they're stupid.
Well, then we have a problem in the room here.
Yeah,
for all the people that are living in Switzerland, I can guarantee to you.
I would like to see those results for once. I would like to see them. I'm pretty sure I'm correct on that.
With regard to what?
Yeah, that the short-term people, that they're not making alpha over time.
Look, there's more dimensions, but please.
Yeah.
Yeah. Look, I think, and you've mentioned it too, the word sustainable returns. We have to define that. And sustainable returns usually in the literature means you beat the index every year. And I think that's a fool's errand. I don't think you can do that. Right. That's, at least us value people will always tell you you can't do that because we get beaten up for long periods of time. We do terribly. So, of course, we would say that. that you don't beat the index every year. The point is if you beat it over a long period of time. And I think if you want to invest in equities and you pick a manager with a particular style, like our style, which is value, or another style, you cannot expect them to outperform in every market environment. If you think you have someone who can tell you which manager is going to outperform in every market environment, good luck to you.
Yeah.
Go switch your money around. I think that's very difficult, personally. So what we do is Kopf haben und durch auf Schweizerdeutsch. It's just, you know, buy cheap stocks and wait until they go up. But that's, you know, we're a niche product. End of story. Absolutely.
Right. Do we have one real question? Thank
There was
you in the
another
back.
one. Yeah.
Thank you for the panel. Investing in Europe has not been easy. Why do you think this is not one of these seasonal swings that we saw, maybe for a quarter? Then volatility comes down, growth is much higher in the US, it's the largest market. 77% of the assets are already there. Yeah, I would like your thoughts on this.
I mean, we also have a huge exposure to European stocks. Our active share relative to the index is 96%, so you're really away from that. Now we believe just because some stocks are listed in Europe, it doesn't mean that they sell not in the US. So for instance, the sausage king producer that I mentioned is producing locally in the US. I'm not seeing the impact yet on the taxes, but let's see. So there are a lot of great European companies that can really work in the world, and I think the same is even more true for Swiss ones, because I mean the Swiss small caps have been always under pressure because they were forced to be better than the others because of the currency that got stronger, and I think that push helped them a lot. And we clearly see a huge potential upside for European companies. The big headwind we have to really clearly state relative to US competitors is the negative energy prices. So Europe pays much higher energy prices than the US. So we are extremely careful in investing in European companies that have really this issue, that they consume a lot of energy, because that's going to be almost a killer for them.
I'm going to contradict you with a perfect example, which shows why you have to be so careful. I mean, generally, you're absolutely right. But I just spoke to Wacker Chemie this morning that has a plant in America, and they have a plant in Burghaus in Germany, 2 plants that make polysilicon, which is extremely energy intensive. And they say that their cost per unit in Germany is lower in spite of the higher energy prices because the people are so much better.
That's true.
40% of the people who want to work for them in Tennessee don't get a job because they fail the drug test. Think about that. Think about that. And the people are just so much, so you have to look very carefully at each company, but you're perfectly right. And so why do we think that this isn't just another flash in the pan, that Europe's going to get better? Well, we have $1 trillion of euro coming our way in the next 10 years thanks to thanks to the German government. So that's going to make a big difference. We've had the nimbus of superiority that the Americans had is now broken. So people look at Europe and say, they're not so bad either. Until now, that was clear that Europe was just, you know, like J.D. Vance said, you know, we're nothing. And I think that's going to change. And I think there's also the algo traders and some of the big hedge funds are now doing a long Europe, short large cap tech trade, which we could see it back and forth. If you look at the correlation between Nestle and Tesla, it's actually quite apparent how on days when Nestle's up, Tesla's down, and vice versa in the first quarter. So there's a lot of money sloshing around like that. It's just this stupid top-down buy Europe, buy USA trade. But that will make European stocks start to go up. And that makes people in this room say, gosh, I have not lost hope in Europe. I think Europe's going to be okay. Let's buy some cheap stocks. Let's buy some stocks with great innovation potential. Let's buy things that are here, because I don't have to buy Tesla alone. I can also buy other things. So I think it gets you into a positive feedback loop.
Right. Quickly, because we're running out of time.
I fully agree on the positive note on Europe, but I will still be kind of cautious, because what we've seen as a rotational play right now is very much also driven by valuation discrepancies. And to be honest, Europe has a lot of things to sort out. A lot of things to sort out. And just you said it's easier to make projections for the next 3 to 5 years. Not sure about that with regard to Europe, to be honest. Are they able to assess themselves in this new geopolitical environment where the US is probably going to play hard? How is Europe reacting to that? Not sure about that yet. Hopefully, yes, positive, but not fully convinced yet.
And probably one element, often Switzerland is lumped into this allocation bucket, Europe. That's when I talk to US investors. But one thing you shouldn't forget, the experiment that Trump is doing right now is really an economic experiment whose outcome we don't know what it will be. But one thing is clear, he wants actually the dollar to weaken to make his manufacturing sector more competitive. So as a US dollar investor caring about your own money, I would think very hard, how am I going to diversify my money? And I'm probably going to end up in a place like Switzerland, and it's already happening. There's actually a lot of money that take refuge out of the US and coming into Swiss private bank like ours. And so yeah, what's the alternative? I'm not sure. I'm also not sure whether Europe is the end game, but there's definitely something to say about also Switzerland within the context of Europe, I think.
Thank you, Damien. So
and if I may add something, we don't know what Trump is deciding tomorrow because it's maybe 180-degree different direction. But what's clear, we're going to see higher inflation rates. And that is basically the best thing for value investing if you look at history. Sorry.
Yeah, no problems. Yeah. So last question, final question. Thank you all for your time. You can catch the panelists afterwards anyway. So last question, quick answers. I start with Damien and we go all the way through back to René. Fast forward 10 years. What's the single biggest factor that will define the most successful active managers?
It's actually, I think, the consistency in the investment process. And I think that consistency allows you to really cut through the signal and the noise. I know that sounds a bit too banal, but I think it's really that. And there's probably more noise going forward.
Thank you. Alex?
I actually yesterday showed a picture of us in the investment committee in SIA in 25 years, AI generated. And I said, in the best case, I think you must have a long-term view. And if you have that, and if you can stay that course, if you have the breadth, not like the pension fund that need to perform every 6 to 3 months, it's fantastic because you have huge opportunities. Thanks.
Great, thank you. Georg?
The value factor.
Thank you. René?
The ability to scale advanced technology and analytics with individual skills.
Super. Thank you all so much for sharing your expertise.
Thanks a lot, Manuela.
It's really fascinating to hear each of your approaches, the complexities of active management. Thanks to everyone in the audience for joining us. I hope you found this discussion as enlightening as I did. Don't hesitate to reach out to them. Now I wish you a fantastic rest of the day, and for your future, a lucky hand in selecting the right investment strategies for yourself or your clients. Thank you.